Hi guys, welcome back to my another video. I'm Nishi Malvi and in this video we are going to study about deferred tax. This is for FRSBI students, okay? FRSBI students. Okay. So deferred tax is a topic where most of the students are still confused and get confused in the exam like what is it, okay? In very simple term, I'm going to explain you first of all whole story behind deferred tax. Okay? Backstory. Story. Okay. So what happened? The tax department, the taxation, UK taxation or UK taxation department said that they will not accept depreciation as an allowable expense. Depreciation as an allowable expense. The reason is this depreciation usually it's calculated on a straight line basis, right? Straight line basis in the sense straight SLB, okay, and it's taken as an estimate. Okay. For example, you purchased a machine for 10,000 pounds. I hope you remember shortcut for pounds. Alter key left hand side plus 156. Okay. Just for knowledge. Okay. Shortcut. Yeah. Let's get back. Suppose you purchased a machine for 10,000 pounds and the useful life of the machine is 10 years. Okay. But for a particular year you had a profit, you had very good profit and you wanted to save tax, you don't want to pay tax. So what you did, you decrease this useful life to 5 years. Now see, 5 years, when your useful life is 10 years, 10 years, then your per year depreciation is gonna be 10,000 divided by useful life, right? So it's gonna be 1,000 per year, right? And if it's decreased to 5 years, then how will it be? Divide by 5, 2,000 per year. So how you do? Usually, whatever the income minus expenses. Expenses. Okay. Now this depreciation is not something which you actually paid, right? This is not actual expense. This is just an estimate which you are showing. So, this is how your profit decreased. Just in books, okay, profit decreased, profit fell down. So that's why the tax department don't allow you to use depreciation as an allowable expense. Therefore you have to always calculate the taxable profit differently. Taxable profit, okay. So the story behind taxable profit, the what you include income, or even if you take this profit, let's take this profit, you have to add back this depreciation expense, right? Whatever the depreciation minus the capital allowance, okay, and then you will get a taxable profit separately. This is what you will get, and on this percentage, on this taxable profit, you will pay the tax, okay, 25% or whatever, 20%, whatever the tax rate is given in the question. Now what happens? Actually, when to know what is deferred tax exactly now? See, deferred tax. Okay, for example, this 10,000 K assets, 10,000 assets, depreciation per month per year, depreciation considering 10 years useful life, okay, 10 years useful life, depreciation is gonna be your 1,000 per month, right? Sorry, 1,000, yes. And the tax department says that for the first year, let's say they will give you 20% capital allowance. So 10,000, 20% is how much? 2,000. Okay. Now if it's 2,000, then from taxable profit you deducted 2,000 at very first. But in future you have to pay more tax, because see, right now you saved, this is an allowable expense, you saved more tax by using this. In future you'll have to uh, pay more. Right now you are saving more, in future you will have to pay more. That's when the temporary difference comes up, okay. And in case, okay, so you will consider 2,000 as an allowable expense, and let's suppose your profit is just 5,000. If you consider the profit based approach, your profit would be 4,000. You have to pay tax on 4,000, but you considering capital allowance. So yes, this is, sorry, I'm considering this as an income, okay, not profit. Okay, income. Yeah. So you have to pay tax on 3,000. You got more allowable expense right now, therefore you will get less allowable expense in future. The very obvious logic is there is no way that depreciation or capital allowance can increase, go beyond the actual value of the asset. Okay, so that's the whole point. Now if you look at it, if you remember the story, then please understand, when your carrying amount of the asset is less than tax base. In short, when your carrying amount is less, okay, then it is allowable, you can say deferred tax asset. I'll explain just a second. And when your carrying amount is more, right now is more than the tax base, then it is tax base, okay, then it is deferred tax liability. Okay, okay, see how you get your carrying amount. How will you get your carrying amount and the tax base? Okay, just a second. Okay, carrying value. Okay, I'm considering here 10 years at first. 10 years. Okay, and your opening value of the asset is 10,000. 10,000. Capital allowance, they say that 20% capital allowance you will get. Okay, so in the sense, this allowable expense will be 2,000, and I'm here considering 10 years as an expense. Okay, so my depreciation here is gonna be 1,000 only, 9,000, and here I'll get 8,000. When my carrying amount is more, in the sense, see, I use this as an allowable expense, but in future I'm gonna get less. It can happen that from the next year you can just get 10% of it. Okay, and here it's gonna follow the straight line method. 10% of it is 800. Okay, so here, see, here your carrying value is more than the tax base. When your carrying a value is more than the tax base, the very obvious logic is you have claimed more expense right now. You have, so that you are paying less tax now, and in future you'll have to pay more tax. Okay. All right. Now let's see this one. When your carrying amount, here your carrying amount is again, your carrying amount is still more, right? It's still more, it's still greater than your tax base. Okay, so again this is an liability. Now if I consider the second scenario where everything is same, 10,000, useful life is 5 years. Okay, and here's 10,000. I'm considering the same 20% at the first year. So 20% is gonna be 2,000, 8,000. 5 years. Oh, just give me a second. I need to consider 15%. Hmm. 15%. 1,500. Okay, 8,500. Here 5 years 1,000. Okay, 8,000. Now see, as an allowable expense, I reduce this amount from my profit. Okay, therefore I'll get uh, more allowable expense in future because I'm using less. Therefore, it's gonna be your deferred tax asset, DTA. That's it. Nothing else. Okay. Now one more thing. One more thing you guys need to see is, just a second. Okay. Now in case of the losses, this will cover FR and SB a whole thing. Okay. In case there is a loss, taxation department allows you to only, if there is a loss, it's your deferred tax asset. Deferred tax asset, right? Because see, there is a loss. Therefore, loss is always an allowable expense. Taxation department never gives you, like, suppose you have a loss, they won't give you money back. Instead, they will tell you that you can claim that particular loss against the future income. So in short, deferred tax asset will arise, right? Now what happens when the taxation department says that there is a loss in current period, you can only make deferred tax asset on whatever expected income you're gonna generate. So suppose you are having a loss right now and in future you are not expecting to earn profit, then how can you set off that loss, or how can you set off that asset? No, you cannot, right? So that's why, that's one rule for losses, that only when expected to earn profits. Okay, now let's understand in case there is an increase in fair value of an asset, which means, suppose your fair value earlier you took 8,000 was the value, right? Now your fair value is 15,000. There is a 7,000 profit. 7,000, sorry, gain. It's not profit, it's gain. Okay, there is a difference between profit and gain. Okay, for especially for when you study tax ATX, it's different. Okay, so this 7,000, you got profit of this 7,000, but in future you'll have to pay tax on this. That's why it is a deferred tax liability in very simple terms. Okay, no need to confuse, it's very simple. Just a second. Yeah, 7,000. This is a gain, right? This is fair value. So you have to pay tax on this in future. That's why it is a deferred tax liability. Okay. This is, on this you will multiply the tax percentage. Suppose it's 20%, then 1,400. This is a deferred tax liability. Okay. Now one more thing comes up, which is goodwill. If there is a gain on goodwill, then this is a permanent difference. Okay, because tax department don't allow this. That's the reason. And then the last part comes up, profit on un uh, PURP, realized profit. Sorry, unrealized profit. Oh, okay, yes. Okay, this comes up when it happens. Suppose a parent sold goods to subsidiary. Okay. Now parent sold 100 units at price of, let's say, 20. So 2,000. Okay. But for parent, the cost was only 18 rupees, and 2,000 out of this 200 is a profit. Okay. Now what happens? The subsidiary didn't sold whole goods in to the outsider. Therefore, or let's say the subsidiary only sold 50 goods. So 100 is something out of this 200 profit. 100 profit is something which is not realized. See, subsidiary recorded this as an inventory. Whatever the purchase subsidiary made, that they recorded as an inventory at this additional price, right? Inventory. And the parent sold goods to subsidiary. It is intra-group transaction. Okay. Now on this intra-group transactions as well, see, parent, of course, on 200 profit, parent would have paid tax. Okay, tax. Let's say 20%. So 40 is the tax. But out of this 40, out of this 200, 100 is only in the intra-group. So 20% of this is 20. So this is your asset, deferred tax asset. Tax asset. The logic is, see, when it is an intra-group transaction, in intra-group transaction, when P2S, okay, P2S. Okay, now let's see, when it is an intra-group transaction, for profits or unrealized sales, okay, per what do you do in the group statement? What is your general entry? Debit and credit. Usually when there is an increase in inventory, you debit it. But here you will do credit inventory. Okay. And debit profit. So yeah, that's why. This profit is reduced. Debit, that's why reduced. Earlier recognized profit, debit reduced. That's why you'll reduce tax as well. But you already paid tax. So you get 10 tax allowable deduction. Deduction. That's it. Deferred tax asset, DTA. So yeah, that's it with deferred tax asset. Uh, I've covered almost all the topics. In case you have any queries, you can reach out to me. Okay, and you can comment down. And for more such videos, please like, share, and subscribe to my channel so that you will get more videos on more subjects. I teach many more subjects: tax, ATX, FRS, BR, and audit. So stay tuned on my channel. Bye bye. Have a good day.